One of the important things for any business is to understand how much cash can actually be taken out of the business without affecting the day-to-day operations and the long-term investments of the business. And one of the ways we can do this is to look at something called the free cash flow. And this is simply going to look at, by taking the profits from the business and adjusting it for things like working capital and long-term investments, how much spare cash is left at the end of the period that could then be taken out and paid back to the finance providers. The basic pro forma for the free cash flow can be shown as follows. First of all, we take the earnings before interest and tax and then simply adjust it for the taxation that needs to be paid for that particular year. Secondly, we can then add back any depreciation for the period, simply because depreciation included in the profit for the company isn't actually a reduction in the company's cash flow. We then need to adjust the figures that we have for any investments that we have to make, because obviously this is going to be a reduction in the cash that the companies have, and then make an adjustment for any working capital, such as purchasing of inventory or paying creditors, etc., which again haven't been included directly within the operating cash flows that we've looked at before. So to see how this works with some basic figures, let's look at this nice simple example. XYZ PLC's earnings before interest and tax is $10 million and has estimated its tax liability for the year to be $2.5 million. The company is planning to invest $1 million in capital investments for the year, which will require an investment in working capital of $500,000. The depreciation charge for the year was $0.6 million. Calculate the free cash flow to the company. So, all we need to do is follow the basic pro forma that we saw previously and simply slot the figures in, and at the end of it we will have the free cash flow for the business. So if we start off with the earnings before interest and tax. So from this question it simply said the earnings before interest and tax were $10 million, so that can go directly into the pro forma. And then the first adjustment we need to make is for taxation. So we're taking the profits in effect that the company has made and then deducting from this the tax that needs to be paid, because tax in effect is a cash flow. So the tax for this business is $2.5 million, which needs to come off, which will give us a balance of $7.5 million. Then according to our pro forma, the next adjustment we need to make is for depreciation. The depreciation figure has already been included in the earnings before interest and tax, but it wasn't an actual cash flow. It was simply an accounting adjustment reducing the value of our assets. Therefore, because we're trying to find the cash figure at the end of it, we need to add back the depreciation charge to the figures that we've already got. So depreciation in this question was $0.6 million. We then have to make an adjustment for all of the investments that the business makes, and we have two types of investments in this example. We have the investment in capital and the investment in working capital. So first of all, we have an investment of $1 million, which is a cash outflow, and then an investment in working capital of $0.5 million. If we then add all this up, this will give us our free cash flow, $7.5 million plus 0.6 less 1 million less 0.5, and we have free cash flow of 6.6 million. What this is fundamentally saying, once we look at the profits made for the company, adjusting it for your non-cash flows such as depreciation, and then taking off all the other cash expenditure we've had to have, this is the amount of cash that is left over for the business for this particular year. This amount of money could then be paid out to the finance provider of the company without affecting the day-to-day operations or the long-term viability of the business. If the company is all equity finance, then the free cash flow that we've just calculated could then be paid out to all of the shareholders. However, if the company has been part financed by debt, then not all of that money that we've just calculated could be paid back to the shareholders, because some of it is going to have to be used to make interest payments on that debt, and at some point in the future we are going to have to make debt repayments if that debt is repayable. So what we need to do is work out what's called the free cash flow to equity, and this calculates the amount of cash that is available to shareholders at the end of every year. Now we're going to follow a very simple pro forma to work out the free cash flow to equity, very similar to what we had previously for free cash flow, but we just have to make sure now that we're going to make an adjustment for any interest payments on that debt along with any debt repayments. And we can follow a very simple formula for this, which is as follows. Your free cash flow to equity is your net income less your net capital expenditure less your change in working capital plus any new debt less any sort of debt repayment. So if we consider this nice simple example, we can see how we calculate the free cash flow to equity. Extract from ABC plc's income statement are as follows. Earnings before interest and tax of $15 million. This includes a depreciation charge of $2 million. We've got interest of $1 million, earnings before tax of $14 million, tax of $4 million, and earnings after tax of $10 million. During the year, ABC plc incurred $4 million of capital expenditure and repaid $3 million of debt finance. So, if we start off with the company's earnings after tax, this has already taken into account the earnings before interest and tax, the interest that's going to be paid, and the taxation. The only real adjustment we need to make to this initial figure is to adjust it for that depreciation charge. So, if the earnings after tax is 10 million, we simply need to add back the depreciation charge that has been included of 2 million. We can then adjust it for the capital expenditure that's been spent. And as per the example, this was $4 million. Now, up to this point, this would give us, in effect, a similar figure as the free cash flow to equity, but includes that interest payment that we've got. We also need to consider that in the example it told us that we've also made a debt repayment. And this debt repayment totaled $3 million. This will therefore give us a free cash flow to equity of $5 million. What this is basically saying, if we consider the profit that the company has made for the period, adjust it for depreciation, the tax, the interest, but also take account of the capital expenditure and the debt repayments, this is the amount of money that is left over that could then be repaid to the shareholders. In effect, it's detailing the amount of money that the shareholders have made from this business and could be taken out of the business without affecting its day-to-day activities.